The junior markets are dead. Now, over the last 10, 15 years, I've been investing and working with publicly traded companies. In doing that, I have built up a large Rolodex of contacts who have decades of experience working with Canadian micro and small cap companies. Every single one of them that I've talked to has told me that this is the worst that they've ever seen things, with the odd person referring to a few months in 2008 as a comparable. But why are things this bad? Well, back in 2022, the Federal Reserve and the Canadian central banks embarked on a path of raising interest rates in an effort to quell escalating concerns about inflation. Little did they anticipate the unintended repercussions of their actions. Of course, one of those unanticipated consequences has been the erosion of a crucial sector within our investment landscape: Canada's junior markets. Just 2 years ago, combined, the CSE and TSX Venture boasted an impressive trading value of $79 billion for the full year of 2021. However, this year they're on pace to finish the year with under $20 billion traded, a 75% cut in the overall trading value over a 2-year period. Now the question becomes, how long does it stay this bad? Also, where are we going to see signs of hope that things are turning? And historically, when it does turn, what are the best sectors to invest in? Today, I want to dive into the data and take a look at how bad it's really gotten out there, and also discuss any bright spots or things we can learn from history. Let's dive in. When we look across the border, the American market has seemed to mostly shrug off the Fed's interest rate hikes. The S&P 500 being led by the Magnificent Seven.
The S&P 500 is led by the Magnificent Seven.
Is up 9% on the year, while the tech-heavy NASDAQ is up more than 22%. Meanwhile, back home, none of our markets are doing particularly well. The TSX Composite, our largest market, is down 2.5% on the year.
Well, the TSX is trading at the lowest level since October 2022, has wiped out all the gains for the year. How should you be positioned?
Which to junior investors, being essentially flat on the year sounds like paradise. The TSX Venture Composite Index is down 9%, which seems relatively good compared to the CSE, which hosts mostly junior companies and is down more than 22% on the year. And with cratering prices comes cratering volume. Let's start by diving into the TSX Venture, where we've seen a consistent downturn in the value of dollars exchanged on the exchange on a year-over-year basis. Additionally, the funds raised and the number of companies going public has experienced a substantial decrease as well. The year 2021 stood out as an exceptional year across the board for the exchange. TSX Venture companies collectively raised an impressive $11 billion in funds, a massive increase from just a year prior where they only raised $6.6 billion. Much of this capital infusion came from new listings on the exchange, amounting to a total of 236, nearly double the number of new listings in 2020. Accompanying this surge in new listings was a broader market boom. Trading volumes for all companies on the TSX Venture swelled to $47 billion in volume in 2021. However, adhering to the age-old adage, what goes up must come down, everything associated with the TSX Venture dropped like a rock. For the first 8 months of 2023, volume by dollar value, which is what really matters, has plummeted by a staggering 72% relative to that 2021 high, down to $9.4 billion. Same goes for IPOs, with only 64 companies having gone public this year on the venture, a stark contrast to the 236 and 161 in 2021 and 2022. And with the tide changing for public companies, they have only raised $3.2 billion this year on the venture, down 60% from 2021 over the same time period. So you're probably saying, well, yeah, 2021 was a great year, but what about before the pandemic happened relative to today? Well, it looks just as bleak, with volume by dollar value in 2018 hitting $30 billion. New listings were also strong at 212 companies, which helped bring in $6.8 billion in capital raised for the year. So even if we took a pre-pandemic year like 2018, we're still down substantially. Now, let's take a look at the real gravesite, the CSE, which has mirrored the ups and downs of the TSX Venture, except with higher highs and lower lows. The exchange, which hit incredible highs during the first year of the pandemic, boomed, recording roughly $32 billion in trading volume in the year 2021. The year 2022, however, proved to be rather challenging. ranking as one of the worst in recent history, with volume by dollar value coming in just under 8.7 billion, which, if you've been keeping score, is about a 73% decrease in trading volume by dollar value year over year from 2021 to 2022. Even 2020, which saw markets come to a screeching halt for half the year, saw some trading volume at $13.6 billion. Now, here's where it gets more depressing. 2023 has presented an even bleaker picture. While the data is available only up to the end of September, it reveals another 50% decline in volume by dollar value year over year, totaling around a mere $3.5 billion. And for those of you who aren't depressed enough, the entire CSE volume for the first 9 months of 2023 is equal to about 35 minutes of trading of Tesla stock on the NASDAQ. That is an entire 9 months on the entire CSE. All their volume added up is equal to less than an hour of Tesla's stock trading. Now that we've looked at some of the high-level data, let's shift our focus to specific companies where investment dollars seem to have vanished into thin air. I could probably name over 50 companies without doing much research in the Canadian junior markets who have followed this path, some of which brought in a substantial amount of investor dollars. One of the most prominent examples is Jervois Capital, an Australian cobalt and nickel mining company, which at one point had a valuation exceeding $1.4 billion, and they raised over $500 million since 2020. Today, its worth has dwindled to a mere fraction of that, around $70 million. This dramatic decline can be attributed in part to the company's decision earlier this year to halt construction at its flagship mine due to plummeting cobalt prices and the impact of inflation on construction costs. Moving on to a company that's likely etched in the memory of those who are involved in the junior markets, let's talk about the Very Good Food Company. This company went public in 2020, and by the beginning of 2023, they had entered receivership. They once had a valuation north of $500 million, and at that, they traded decent volume. Another example is BBTV, which in 2020 raised $170 million in their IPO transaction at $16 per share. They just went private last month at roughly 38 cents per share, a valuation that brought them to roughly $8 million. Another example is Else Nutrition, which once boasted a market cap of over $300 million in 2021 and raised $55 million. They are now worth only $20 million in market cap. Of course, I've got to bring up Mind Medicine, which saw its shares spike as investors poured over $300 million in capital into the company, all while being recommended by Mr. Wonderful himself.
I have something I want to talk to you about. I want you to fund me to bring LSD, MDA, psilocybin mushrooms as medicines.
This company at its height boasted a valuation of over $1.7 billion. Today, the market cap is down over 90% at a mere $145 million value. So let's move on. With the struggling junior capital markets, it's obviously spilled over into the investment banking world, especially here in Canada, with many dealers seeing the slowdown in the junior markets and now laying off staff. The majority of these layoffs began during the summer, a period when investment activity traditionally hits its lowest point. Canaccord, for example, laid off the majority of its capital markets desk, waving goodbye to 75 people. Ditto for the major banks. Bank of Nova Scotia, Royal Bank of Canada, and the Bank of Montreal have recently announced plans to reduce their workforce by 2 to 3%.
Now, Scotiabank announcing 3% of its workforce being let go.
Scotiabank has had a presence in the Caribbean for more than 130 years. And today, the Canadian bank, one of this country's biggest, revealed it is slashing its workforce.
Well, these job cuts aren't directly linked to the investment banking division. They serve as a reflection of the current economic climate. Investors should see this for what it is, a sign of the times as we approach what appears to be a technical recession, which according to Bloomberg is already here. Things are bleak. Canada is in a technical recession, trading volumes have never been lower, and most mornings it's hard to wake up, look at your screen, and see something positive. But this is how cycles work. Eventually things will get better. They always do. And when they do, the question is, do you need to already be positioned, and what does the positioning need to look like? The last time we exited a low volume period like this was in 2008-2009, which saw the introduction of the words quantitative easing. Next thing we know, commodities are ripping. The market value of mining companies listed on the TSX Venture from the end of 2008 to the end of 2010 increased nearly 380%. Of course, we don't know how things are about to play out from a central banking standpoint or a geopolitical standpoint, so it wouldn't be wise to just assume that we're going to follow the exact same pattern as we did after 2008, 2009. And although it's easy to come on YouTube and listen to a guy like me and expect easy answers, it's not that simple. It's the hardest thing about all this, is that it's not easy to predict the future. The Canadian junior markets had their commodity run in the early 2010s, followed by a number of dry years with the occasional pop in things like lithium. That was then followed by a cannabis boom, which then saw a brief psychedelic boom, and then we saw the everything boom in early 2021. And if any of these bubbles or pops were easy to predict, we'd all be multimillionaires. But chances are that risk capital is going to follow into whatever sector a successful operator pops up in. It could be battery metals, AI, life sciences. Again, I don't know. But the thought I'm going to leave you with is this. Things are never as good as they seem when things are going really, really good. And things are never as bad as they seem when things are going really, really bad. And right now, things are really, really bad. So I hope if you're watching this, we can connect in the future when things turn, because it will eventually turn, trust me. And when it does, we can remember these times to keep ourselves grounded. Ultimately, this game is all about perspective, survivability, and learning from outcomes and our mistakes. All right, everybody, thank you for watching. If you could do me a big favor, please smash that like button, subscribe, and ring that notification bell. Also, let me know what you think in the comment section. So guys, we just recently launched this channel and we noticed that 99.9% of our viewers are not subscribed. So if you enjoyed this video, we need your help in growing this channel. By subscribing, that would help us keep the lights on and make sure that our crews have jobs in these uncertain times. So please hit that subscribe button, and we promise to make more quality videos that I'm sure you're gonna love.